Hey, what's up, everybody? Hey, everyone. We are about to go live and talk about the benefits, understanding the value of life insurance. I'm going to give about, let's say, about 5 more minutes so people can jump on so we can get started. And comment if you're here. I'm excited about teaching this class, teaching, doing like a lunch and learn. So you can eat lunch and be able to learn something about the benefits of life insurance. I'm going to be putting some things up as well that you can schedule an appointment with me once you're ready. Hope everybody is having a great day. Okay, this is the link to schedule. We're gonna be going. Give about 2 more minutes, and we're gonna get started. So hope you all are excited about it. I'm ready. So we're gonna give about 2 more minutes, and we're going to get started with talking about life insurance and answering any questions you might have. Okay, so I put up a link to schedule a life insurance review or other any other type of reviews that you want to schedule, as well as put up access to my website. So let's go ahead on and get started. I am going to share. If you all can share this, who on here can share it, can let people know that I'm live. That would be great. This is my first one, y'all. So kind of excited about it. So I'm about to share mine a little bit so we can get started here. Okay. All right, so let's get started. Um, so this hour of Insured Up is going to cover understanding the value of life insurance. My name is Dr. T, your host, your insurance professor, your all things business and insurance and finance. So I'm excited about this. I'm excited about discussing the benefits of life insurance, why is it important, why is it needed. And so let's go ahead on and go through it. Okay. All right. Hold on one second. Let's see. Okay, we definitely have a disclosure. This is disclosure is to let you know that I am this is not any a legal or tax representations. This is just information to provide you with. You still need to contact your lawyer. You still need to contact your accountant to make sure that everything is lined up with IRS and all legalities. This is informational purposes only. Okay. All right. Life insurance. Many times people get life insurance because wants to distribute money to the beneficiaries, want to pay off a mortgage, so the house is free and clear of debt if something was to happen to them. Also wants to provide children's college education. And as we know, some life insurance policies comes with long-term care, chronic illness, critical illness. Um, some of them also comes with Alzheimer's coverage, and so this is the need for life insurance to kind of cover some of those gaps. Hey, TT. Also, it pays for the final expenses of a funeral or estate settlement costs. It provides an emergency fund to handle an unexpected financial crisis, provides settlement of personal debts, and it also can be used for retirement. So I'm excited to dive in a little bit for this about an hour and answer any questions you might have when it pertains to it and see how you can benefit from it. See if it's something that you learned something that you didn't know or enhance your learning on life insurance. So these are some of the risk factors that insurance carriers look at. Your age, your gender, your height and your weight, your medical record, personal habits. Are you a smoker, drinker, drug use? That goes into play. Your occupation, the amount of coverage required. So all of those risk factors goes into play when we start talking about understanding life insurance and the value of it. So many life insurance policies come with what we call accelerated living benefits. So these accelerated living benefits provides the potential to receive partial or full benefits if diagnosed with a qualified medical condition. And so, just to give you like a brief summary for terminal illness, if you have a medical condition that results in death within 24 months, you can use some of your benefits to pay for some of those expenses. Chronic illness, unable to perform 2 of 6 daily living activities for at least 90 days due to cognitive impairment. You can use some of your life insurance benefits to pay for some of those expenses. Critical illness. If you diagnose with a critical, like examples of heart attack, stroke, invasive cancer, paralysis, loss of limbs, many others, this can also provide you with some relief of using some of that benefit to pay for some of those medical expenses. Okay. All right, TT. You're gonna have to email and remind me that to tell Miss Kathy that. So these are some important things to have when you're looking at your life insurance policy. And most of the time, you got to have a minimum of $50,000 to qualify for these benefits, as well as meet medical underwriting as well. So let's get into the types of life insurance. We got term life insurance. We got the cash value life insurance policies, your index universal life, your variable life, your whole life. It's one that's on here. It's missing. It's a guaranteed universal life policy as well. It's not a cash value, but it's a pretty good policy. And we're going to talk about that one. So, term life. If you know anything, you know term life are lower premiums for more coverage, covers you for a term of 1 or more years, is used for mortgage protection. Most policies can be canceled or renewed at the end of the term, but sometimes they're usually more expensive each time you renew. So let's say, for example, you got a term policy right now and you locked into that rate for 20 years and you 30 years old, right? So you got about 150,000, 200,000, and you qualify for the preferred. So you're paying about $30 a month. So let's say in 20 years, you 50 years old. It's going to renew on how much it costs to insure a 50-year-old in 20 years. So at the beginning, the premiums are low, but once it renews, they can be way higher. Also, it does not earn cash value and it pays a death benefit only if you die. So, and usually can be converted into a permanent policy. So, some of these term life policies, you have a certain amount of time to convert those into a permanent policy, which is good because you don't have to go to proof of insurability. So, let's say you got a 20-year term and you have like 10 years to convert that. Also, depending on your age as well. You can convert it without having to show proof of insurability, which is good. Because sometimes things can happen within that time. You probably get a illness, get some medical conditions that kind of would not qualify you for a life insurance policy, or have your premiums to be higher based on those medical conditions. All right. So this is the one I was talking about. We also have a permanent policy called Guaranteed Universal Life. It covers a death benefit to age 121. One of the things I love about this policy that you can cancel it in 20 years or 25 years and receive all the premiums paid into the policy. So it's like okay, if I don't want this policy in 20 years, I can get all the premiums I paid in, all the money I paid in back to me, or in year 25. So, or you have the option to pay this policy off in 20 years without any future premiums. That means you can have a paid off policy in 20 years. It doesn't build up cash value, but many people use this for mortgage protection instead of a term life policy because they love the fact that they get their money back if they don't have to use it. So it's a good win-win situation to me on that one. Then we go into our cash value life insurance policy. This is where many people get the concept of build your own bank, infinite banking, because it earns interest and grows tax deferred. You can borrow against the cash value. The great advantage of borrowing against the cash value, the policy loans doesn't appear in your credit report. The loan accrue with a fixed or variable interest rate, and you can use that as a down payment for a house, buy a car, pay off debt, medical expenses, start a business, and many other needs. The outstanding balance and interest deducted from your payout if loan not repaid before your death. So let's just say something happens and you pass away, you did not pay off your balance of your loan. So they're going to deduct that balance plus any interest from your payout to your beneficiaries. So let's say you have 100,000 of death benefit, and also that you had some cash value that's going towards the death benefit as well. So you probably have about 100, let's say $170,000 as far as death benefit, but you borrowed like 20,000 or 20,000 from the cash value. If you didn't pay that 20,000 back before you passed away, they would deduct that 20,000 plus any interest that's accumulated from that 170,000 buyout, which is still not bad. so so that's why most policyholders set up the policy to obtain some of the cash value with reducing the payout to beneficiaries. Because remember, when you really setting up a cash value life insurance policy, it's a benefit to use while you live in. You want to use that cash value while you live in. So to what? To pay maybe a down payment on a house, buy a car, pay off debt, college expenses for your kids, your grandkids, your nieces, medical expenses, start a business. Where I'm at now, use some of my cash value for a down payment on the building I bought in Forest Park. And so, but you want to make sure that you know exactly what you're using that life insurance policy for. Any questions here before we move on? Right? And you could just type them in the comment, like, share, subscribe. Definitely share this if it's something that you think it would be beneficial and educational to anyone. Okay, so also you could take partial withdrawals from that. But that part, when you take a withdrawal, that's when it becomes taxable. If it include investment gains, the investment gains, that portion is taxable and it reduces the payout to the beneficiaries. Also, cancel the policy and you can receive the cash value minus any surrender charges. So if you're just using this to pretty much, let's say, save your money, on a better interest than putting into a regular savings account, that's cool. Some policyholders buy life insurance policy because the cash value is better than what? The interest made in a savings account. And so some participant whole life insurance policies accrue dividends. So you got the dividends accruing plus the cash value that's building up. And you have options on those dividends to distribute it as cash, add to your cash value, or pay premiums or buy more life insurance. And so there are many options with these cash value life insurance policies and how you can build your own bank, how that build your own bank concept came up, as well as infinite banking. The key to this is making sure the policies are set up sufficiently and efficiently where it's doing what it's supposed to do. These are the tax benefits. It has tax deferred growth potential. Don't have to pay taxes on the cash value growth in the policy. It has a tax exempt distributions. Loans taken against a life insurance policy's cash value aren't subject to income taxes. So if you take a loan against your policy cash value, they are not subject to income taxes because it's a loan. It's a tax exempt inheritance. In most cases, beneficiaries don't have to pay taxes when they inherit the death benefit. And then it's a tax exempt death benefit accelerations. The living benefits for major illnesses take a set percentage to help for medical care. So you get like, I think, three benefits from this. You get your living benefits, right? Then you also get the cash value. Then you also have the death benefit. That's pretty good. You get three benefits from this cash value life insurance policy. And I like going more into these because it looks at it more as a way of these benefits you can use while you're living. You don't have to wait. Everybody said you get life insurance to build generational wealth for your beneficiaries while you're dead. No, you can start building that generational wealth while you're living and helping your family out, preparing a legacy or a dynasty while you living. Okay, whole life. It covers you to age 121. So now we're about to get into the different types of cash value life insurance policy. The one that's been around for years. This is the one where they used to come around and pick up the money. Y'all remember those? My mom used to have one of those when the agent used to come around and pick up the money. I know you do, TT. Covers you to age 121. Premiums do not change. Benefits do not change while policy is in effect. It accumulates cash value more slowly. It's better to buy when you're young. And also, I'm going to show you some examples of how this cash value builds up in the index universal life. Whole life policy's been around for a while. They build up a cash value way more slower. Some people like them because the premium never changes on it. Um, but also, you're looking at a policy that takes forever for that cash value to build up like you want. Unless you can find one that has more options to it. But the good thing, the caveat about this one too is that this one has dividends. So if you get with a company where they're paying dividends, you can also have those dividends where you can compound interest and have those dividends building up as well as part of your cash value. So it just depends on what's your risk level is and which one is more comfortable. This one right here is the one that I love. You're gonna see why. The Index Universal Life Insurance, it's a death benefit as well as the ability to build accumulation value with tax deferred benefit. It has the potential to earn interest based upon the performance of an index. So you're not tied into a fixed interest rate like a whole life policy. It is never invest. The good thing is that it's never invested directly in the market, the stock market. So policy would never be credited a negative interest rate, meaning that, if you directly invested in the stock market, you have the potential to lose everything you've gained. With this one, that won't happen if it's set up right. And that means that, say, for the last 10 years, your cash value has accumulated so great that it's been doing so good because the S&P 500 has been performing well. But then this year, it was no gains. Now, if you was directly invested in the stock market, you lose mostly all your money. Here, you won't lose any of the money that you've already gained. You just won't have any gains for the current year, which is good. So we have that We have what we call that power of zero protection on here. And so it really helps that so you won't go into a negative interest rate. You have three different options for paying death benefits to your beneficiary. I always like to choose the one where for our clients, where the death benefit is the face amount plus the cash value that's accumulated. Whoever you work with for this, make sure they choose that option. You want the death benefit plus the cash value that has accumulated to be the payout. Okay. So variable life insurance, that's one that's based upon the investment performance of the account. So with that one, you kind of are directly invested in the stock market. You invest in mutual funds or other investments. They have a higher cash value and death benefit if the investment performs well, but you can risk of losing all of your death benefit and your cash value. And I know many other people who I deal with, they like they like aggressiveness, but they also like surety and security as well. And so that's why I go to the Index Universal Life policy because it provides the best of both worlds. All right. So you need to review your policies every time you get a new driver, you get married, your kids graduate from high school, you get engaged, buy a home, move to own apartment, have a baby, graduate from college, turn 25, get a new job, buy a car, and move to a new city. Those are important to always kind of review your policies, make sure they're still up to date, and make sure that it's doing what they're supposed to do. So now let's look at some options here. All right. So this is how your cash value life insurance policy can perform. We're going to first look at the top part. If you all can see this, um, an example of contributing at least $250 a month for children. So if we look at the newborn, if you was consistently contributing about $250 a month to that policy, in 10 years, the cash value in that policy would have accumulated up to $33,925. That's not bad. By the time they turn 20 years old, it have about $99,245. And this is only like this is just being what we call conservative. It has the potential to grow way more than this. But I wanted to like give like some kind of like towards some conservative figures and not go too out of the board with it because it has the potential to even grow even bigger than this. In 30 years, that means this newborn is 30 years old. It's a cash value. They got cash available to them at about $216,030. Now, what if some of us had that when we got to 20 and 30 years old? I know I wouldn't have any student loans. I do know that much because I would have had enough for college right there, part of my college. Then 30 years, some of us we buy a house in 30 years. That would have been enough to put down a down payment as well as shown that I had some cash on hand. And then if this person keeps this policy, let's say they keep it by the time they turn 67, they have about $2 million in there. So let's just do some calculations. They're doing 250 a month. I'm about to do some calculations here on my phone. You're looking at about 250 a month times 12. That's $3,000 a year. And so this is a newborn. So let's multiply this by 30 because I'm gonna see how much you contribute. That's $90,000 you contribute. But of that 90,000, you got 200, you done made about 216,030 dollars on 90,000. So you subtract that 216,030. So you made about $126,000 on that policy, plus your 90,000 that's in there. But let's even go even further. Let's put in 250 times 12, multiply that, let's say by 67, right? That's $201,000. So $201,000 generates a return of 2 million. Wow. And then they still have that death protection of 146,578. That's not bad. That's not bad at all. So these are for kids. I wanted to kind of, take a look at that. You can see 5-year old, 10-year old, 15-year old. They're still getting like a good rate of return. You see, the younger you get into this, the more it has the time to grow. Let's come down here because I did do some for the adults, and it had to make sense. So it's like if you contribute about 15,000 a year, 15,000 a year is, let me see, divided by 12, it's about $1,250 a month. And I know many people say, wow, that's a lot of money. Honestly, we spend that on a lot of stuff in a month if we look at it. If we and I look at this too, that $1,250 can be part of what we put in a savings account that's not even generating a penny on the interest. Where here you got at least 6% or more that you can that you can make on your dollar. Just think about that. So if you start at 25, putting in 15,000 a year in 10 years, that cash value has the potential. You remember this being modest has the potential to grow to $183,079. Wow, that's better than putting in a savings account, a regular savings account. But this 25-year-old starts then, about in 30 years when they'll be 55 years old. Look at how their money grows, and they still have this death protection. So again, you got three benefits here. You still got your death protection that covers if something was to you were to pass away. You remember the living benefits we talked about: critical illness, chronic illness, terminal illness, and even some policies comes with long-term care and Alzheimer's as well, as far as living benefits. So we're looking at 15,000 a year. We multiply that, let's say by 20 years, that's 300,000. They made about 526,000 on their money. So let's also do 30 years, 15,000 times 30. Oh, no, that's not right. 15,000 times 30. So that's 450,000, where that money has grown to about that 450,000 has grown to about 1,140,122. That is not bad. And so you see, even at 50 years old, if you get started a little bit later, it's still you look at it, it's not it's of course we're not going to get at the 2 billion because we're looking at 16 years compared to this person had how many years to grow that money? About 42 years compared to 16 years. And so you look at the earlier you start, the better you see it. And you don't have this is just contributing 15,000. We could look at 20,000 a year, we could look at 30,000 a year. And the good thing about the index universal life is that let's just say you contribute like this 15,000 for the last 10 years or whatever, and some financial hardships came around and you can't contribute that much. This one has what they call a flexible premium. So you can call the insurance carrier and say, "Hey, I'm having some issues right now. How much can I contribute?" Where I contribute less than that and still make sure the policy doesn't cancel and it's still building up some cash value. And they'll be able to tell you. So that's the good thing about this policy too is the flexible premium. And that's why I love this type the index universal life policy. It has the potential to really provide a one of many avenues of building your own bank or infinite banking, building a legacy for your family while you live in. And I love it when my grandparents call and they want to get a policy on their grandchildren. And hospitals had it right off the bat. You remember when a newborn is born at a hospital, I think they already give them like a Gerber, like talk to them about Gerber life insurance. But it's but you also but because they already know it's better to start young. But we also want to make sure those policies are doing what they're supposed to do, building a legacy, building generational wealth, building a wealth that's going to grow how it should grow, where you can really see like a nice return on your money and on your investment of a life insurance policy. Any questions before we move on? So when you buy life insurance, discuss your needs with a licensed insurance agent. If you get with an insurance agent and they trying to sell you from day one, run away. I like to do what we call a discovery call. See where you at. Talk to you. Ask some questions. Decide how much you need. Decide how long you need the coverage. Decide what can you afford to pay. Because we don't want you to get this policy and then you can't afford it. Learn what kind of policies fit your needs. This index universal life might not fix your needs. A guaranteed universal life might not fix your need. A whole life might not. We have to really see which one fits your needs and purchase coverage that fits your needs. So that goes through a process of what I like to call making sure the client's needs are met. So we do like a discovery call here. That discovery call lasts 1 hour where I'm just asking you questions about your goals, your financial goals, where you at now, as far as income, as far as debt, how are you saving your money now, what other types of retirement vehicles you have in place, or other type of things you have in place to grow your money. Those are the things I ask first. What life insurance you already have in place? I've heard people say, well, I always know I need to get another policy. You can never have too much life insurance. I don't know who came up with that. The point is the life insurance working to fit your need? You can have one policy and it fits your need. But that's why we have to get into the nuts and bolts to see exactly what do you need. And so that's the end of this presentation. Are there any questions? Um, I'm here. I'll be here for about 2 more minutes if you have any questions. But that's the end of it. I hope it was something that you all can take with you. All right. I thought this was gonna thank you so much, Kay. Thank you, thank you. Thank you, TT. Thank you all so much for coming on and watching. And I hope it was something you guys can take with you. If you want to get a copy of this presentation, please email me. You can email me at info at Pearson Consulting Group LLC.com. And I just put it in comments as well, where you can email it to me. Email me that you want a copy of this presentation, and I will get it sent out to you. All right, everybody have a great, great day. See you on the next fourth Wednesday where we're going to be talking about retirement reimagined. Okay, have a good one.